Stop looking for perfect stocks. Seriously. If you're waiting for a stock with perfect relative strength, perfect base, perfect everything, you will never buy. Here is the counterintuitive truth that experienced traders understand. The best stocks often have one flaw that scares retail investors away. 5 Dow stocks are setting up near buy points right now. Nvidia at $215, Boeing at $236, Walmart inches from a handle entry, Apple in a new buy zone, Goldman Sachs with 31.5% margin of safety. They share one common flaw: lackluster relative strength lines during base building. But here's the secret: that's normal for leading stocks. It's not a warning sign. The Dow just hit 49,617. S&P and Nasdaq are near record highs. AI sentiment is strong, but Iran tensions could thin the market. Let me break down all 5 stocks, and stay until the end for the 3 secrets that will change how you spot the next breakout. Narrator, slightly softer, relatable tone. I'll admit something. I used to avoid stocks with weak relative strength lines. I thought, if it's not outperforming the market, why buy it? I missed multiple breakouts because RS lines often weaken during base building. The strength comes after the breakout. Today, I'm going to show you 5 Dow stocks setting up right now. We're going to look at each stock's buy point, the common flaw, the earnings catalysts, the analyst targets. By the end, you will understand why this flaw is actually a feature for disciplined traders. Stay with me. Narrator. Let's start with the AI king, Nvidia, NVDA, trading around $215 per share. Buy point, $216.82, high handle pattern. The setup: Nvidia is forming a cup with handle base, a classic bullish pattern. The catalyst: Q1 earnings are due May 20th. Analysts expect 118% EPS growth. The flaw: the relative strength line has been lackluster during base building. Is that a problem? No. This is typical for leading stocks. The RS line often flatlines or drifts during consolidation. The counterintuitive truth: the RS line weakness is not a warning, it's the pattern. Strength usually returns after the breakout, not before. Verdict: watch the $216.82 level closely. If earnings deliver, this could be the launchpad. Narrator. Next up, Boeing, BA, trading. Near $236.45, a cup with handle buy point. The catalyst: Jefferies just reiterated a buy rating with a $295 price target. That's about 25% upside from the buy point. The flaw, same as Nvidia, lackluster relative strength during base building. The story: Boeing has been recovering from years of production issues and regulatory scrutiny. The aerospace cycle is turning. Airline demand is strong. Defense spending is up. The counterintuitive truth: Boeing's flaw is the same as every other stock on this list. Weak RS lines during consolidation are not a reason to avoid, they're a reason to watch. Verdict: if Boeing breaks above $236.45 with volume, the $295 target becomes plausible. Narrator. Now a defensive play in a tech-heavy list: Walmart, WMT, currently trading just 1% below a handle entry point. The catalyst: Barclays has an overweight rating with a $132 price target. The story: Walmart is winning the retail battle. E-commerce is growing, advertising business is scaling, grocery is rock solid. The flaw: you guessed it, relative strength has been lackluster during base building. The counterintuitive truth: Walmart is not a momentum stock, it's a quality compounder. Weak RS lines are more common for defensive stocks during base building. Verdict: a defensive stock setting up near a breakout. If the market gets choppy, Walmart could be the safe haven that also breaks out. Narrator. Next, the world's largest company, Apple, AAPL, trading around $293 in a new buy zone. The setup: recent breakout has been confirmed. The story: new MacBook Neo, iPhone 17 momentum, services at all-time highs, $100 billion buyback. The flaw, same pattern, RS line weakness during base building before the breakout. The counterintuitive truth? Apple already broke out. The confirmation is there. The flaw is in the rearview mirror. Verdict, already in buy zone. But if you missed the first move, watch for a pullback to the breakout level. Narrator. Now let me show you the most interesting stock on this list. Goldman Sachs, GS. Trading around $936. The value case. Discounted cash flow, DCF analysis, suggests an intrinsic value of $1,368 per share. That implies a 31.5% margin of safety at current prices. The catalyst, Q1 earnings showed $8.8 billion in revenue, 53% gross margins, 40 billion euros full-year guidance. The investment banking cycle is turning, M&A is recovering, asset management is growing. The flaw, same as the others, lackluster relative strength during base building. The counterintuitive truth? Goldman has the most upside of any stock on this list. The DCF says $1,368. That's
46% above current prices. If the breakout confirms, the risk-reward is exceptional. Verdict, the highest potential upside, but also the most dependent on market sentiment. Now let me explain the flaw that all 5 stocks share. What is relative strengthers? Which measures a stock's performance compared to the overall market. RS line going up means the stock is outperforming. What's happening with these 5 stocks? During base building, their RS lines have been lackluster, flat, or slightly down. Why is this not a warning sign? Because leading stocks often have weaker lines during consolidation. The market takes a breather. Stock builds its base, momentum slows. When does RS strengthen? After the breakout. When the stock clears the buy point with volume. Institutional money pours in. That's when their line turns up. The counterintuitive truth? Buying when RS is weak during base building is how you get the breakout. Buying when RS is strong after the breakout is chasing. Weak RS during basing is a feature, not a bug. So what should you actually do with this information? If you are a breakout trader, watch these 5 levels. 1. Nvidia $216.82. 2. Boeing $136.45. 3. Walmart handle entry 1% below. 4. Apple $193 already in buy zone. 5. Goldman, watch for volume confirmation. Wait for volume. Breakouts on low volume often fail. If you are a value investor, Goldman Sachs at $936 with a $1,368 intrinsic value is the best risk reward. 31.5% margin of safety, 46% upside to DCF value. But be patient, value can stay undervalued for longer than you expect.